The webinar will begin in 1 minute. Welcome, everyone. Thanks for joining us for today's webinar entitled Life Insurance and Tax Uncertainty. The webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sujas. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Lineberg, and he regularly speaks at industry events. Before I turn the floor over to Linus, we're going to vote on December's webinar. And as a reminder, on November 5th, we will discuss dynasty trust planning. So mark your calendars for that one as well. The topics up for your consideration for the December webinar are private letter ruling confirms spousal stretch availability, estate tax mistake costs $1.5 million, or managing Medicare Part B premiums. I'm going to launch the poll, and I will give everyone a minute to vote. All right, just a few more seconds to get those last couple of votes in. All right. It looks like the December webinar will be Estate Tax Mistakes Cost $1.5 million. Thanks for participating, and now I am going to turn it over to Linus.
Thanks, Jennifer, and welcome everyone. We're pleased that you've joined us for today's webinar titled Life Insurance and Tax Uncertainty. As a reminder, we invite you to join us for next month's webinar. Our webinars are held on the first Wednesday of every month, and next month's webinar will be held on Wednesday, November 5th at our normal time, 11 a.m. Central. The topic next month is Dynasty Trust Planning. If you know of someone in the life insurance industry or in the financial services industry who would get some benefit from joining us in our webinar, feel welcome to pass the invitation along. Our webinars are free and open to everyone in the financial services arena. Let's go ahead and get started with today's content, life insurance and tax uncertainty. We're going to use four specific examples of life insurance related tax uncertainty. We're going to start with the loan exchange ideas in connection with 1035 exchanges. The loan exchange idea is supported by private letter rulings, but there still is some tax uncertainty associated with it. We're going to then move on and talk about third-party chronic illness acceleration. We'll talk about the possibility of a term insurance to an annuity 1035 exchange, and then finally we'll finish up by a short discussion of restricted property trusts and the tax uncertainty associated with them. So let's go ahead and get started with the first example, loan exchange. Those of you who've had some experience in the life insurance industry know that it's possible to exchange one life insurance policy for another on a tax-free basis. Even if there's gain in the existing contract, exchanging to the new contract, if you follow the procedures correctly, will not result in the policy owner recognizing any gain on the exchange of one policy for another one. But one thing that ends up being a surprise to those who haven't run into it before is the idea of taxable boot. And that is where somebody exchanges one policy for another, but holds back something of value as part of the exchange, like cash. The IRS has a special rule that says that whatever you hold back as part of the exchange, whatever doesn't get exchanged over to the new policy, it comes out of the old policy and it comes out gain first. And the common way where folks run into this and end up being surprised by it, don't let this happen to you, is if the old contract has gain in it and there's an existing loan against the old contract. The IRS has said if a loan disappears as part of a Section 1035 exchange, that loan disappearance is treated just like the policy owner got that loan forgiveness in cash. That is, the loan forgiveness is taxable to the extent there is gain in the existing policy. And that is a surprise to many. Well, years ago, when this problem was recognized, carriers came up with a solution which was based on the logic in several private letter rulings. In those private letter rulings, the IRS said that if you've got a policy that is subject to a loan, if you exchange it for a new life policy subject to at least the same amount of indebtedness as the old one, then, the IRS said in these private letter rulings, that is a valid 1035 exchange and you are not required to recognize any income tax on the exchange of contracts from one carrier to another. And we sometimes refer to these kinds of Section 1035 exchanges as loan exchanges. The problem is that people don't know about this. I've mentioned that more than once already. But a lot of carriers don't want to accept exchanges under these terms. They don't want to issue a new contract subject to an immediate loan, even if it'll facilitate a substantial 1035 exchange, just because it's hard to do. From a systems perspective, it's hard to issue a new policy subject to a loan. And also, if the motivation to do the loan exchange on the part of the policy owner is because the old policy is failing, because the loan balance and the loan interest is getting bigger and bigger every year, and it's causing stress on the policy, even if it's exchanged for a modern policy subject to a loan, in a lot of cases the modern policy will also be subject to the same kinds of stresses. So a lot of carriers have shied away from Section 1035 exchanges that have loans involved. But even if you find a carrier that does do a loan exchange, you should know that the loan exchange program is not without some tax risk, because the authority that we're relying on are private letter rulings. And private letter rulings are really not authority at all. They can only be relied on by the person to whom the private letter ruling was issued. So there is some tax uncertainty with a loan exchange. While I would personally feel comfortable in pursuing a loan exchange if I found a carrier that would process one, an accepting carrier that would process one. Um, uh, that doesn't necessarily mean it's without risk, and I would certainly want to let the client know about what that risk is. So that's number one on tax uncertainty. That's probably the least risky idea, least tax uncertain idea that we're going to talk about. So let's go on and talk about third-party chronic acceleration, which, as you can see in the notes, is supported by logic and hope. What we've got is we've got section 101 of the Internal Revenue Code that says life insurance death proceeds are generally income tax free. And the IRS added code section 101G some time back, and that says that life insurance benefits paid when somebody's chronically ill will be treated like tax-free death proceeds. That's the good news. So most chronic illness accelerations, when they're paid to the insured, are going to be tax-free. On the other hand, Section 101 is silent about what happens when an acceleration is paid to a third-party owner of the contract, like an irrevocable trust or, say, one of the insured's children. It's the policy owner who elects the acceleration, and when that acceleration is paid to that person, the question is that treated as a tax-free death benefit or not? Code Section 101G is silent on that issue. Code Section 101G does say explicitly that if the acceleration is paid to a business, then it's taxable. It's not a tax-free death benefit. And so what's implied by that is that if it's paid to a family member or to an irrevocable life insurance trust, under those circumstances, the acceleration will still be income tax free. But we haven't had anything explicit from the IRS that says that. And so it's likely that it's going to be tax free. But then again, that position is supported only by logic and a little bit of hope. And so advising our clients about that circumstance, if we've got a third-party owner of the contract, we should also tell them if there's an acceleration for chronic illness, the insured's chronic illness, we are not 100% sure whether the benefit is going to be taxable under those circumstances because the IRS has never said. One other thing that Jennifer and I often get asked about is the possibility of a term insurance to an annuity 1035 exchange. And the idea makes some logical sense, right? So let's say we've got a term insurance product. It's a 10-year term product, and the premium for the term product is $10,000 a year. We get 10 years in, we've put in 100 grand into this term product, and we're not going to keep the term insurance anymore. What we'd like to do is we'd like to preserve the $100,000 that we've paid into the term policy as basis for an annuity purchase. So if we put another 100 grand into an annuity, for example, and we do 1035 paperwork from the annuity carrier or from the term insurance carrier to the annuity company, in theory we'd have a $200,000 basis in the annuity contract with only $100,000 of new cash value, right? Because that's the new cash we put in. And so what we'd be able to do if the logic works is we'd be able to mask a lot of growth and we wouldn't have to pay income tax on gain until the contract generates a full $100,000 of gain going forward in that example. And so it makes a lot of sense for somebody to try to pursue a term insurance to an annuity 1035 exchange. But based on what we hear from carriers, they really don't want to process it If you do find a carrier that will allow for our annuity or term insurance basis to be transferred to the annuity contract, um, you're going to have to get cooperation from both the sending and receiving carrier in order to pull it off, because both have to participate in a 1035 exchange. If you're doing an internal exchange, you'll only have to convince one carrier. But even if you get a carrier that is willing to do the exchange of a term policy for a deferred annuity, the client has to understand that there's risk involved in this. Code Section 1035 doesn't really deal with the possibility of doing a term to an annuity exchange. Some can argue that the words in 1035 don't say that you can't do it, but the idea that you can do it is really supported mostly by hope and the fact that the code section itself is silent about this particular issue. So there is a fair amount of tax risk, tax uncertainty involved with the term to annuity 1035 exchange, even if you can find a carrier or carriers that are willing to help pursue the process. So let's talk about the last idea, which is the riskiest, the most tax uncertain idea on the list, the restricted property trust. I'm not going to get into a lot of detail about how restricted property trusts work. They were developed a few years ago. The idea was to create tax leverage for business paid life insurance, usually on one or more of the owners of the company. The main objective of a restricted property trust was for the business to get an immediate tax deduction for the premium on the employee's life policy, but for the employee to be able to delay the timing of the recognition of the corresponding inclusion in their taxable income. And really, the restricted property trust strategy has been outlawed by the IRS. The IRS has prevailed in two court cases, the Mann Construction case and the McGowan versus United States cases. And so it's no longer, in our opinion, feasible to pursue the restricted property trust strategy, even though that's not necessarily for sure. It is possible that if somebody decides to appeal the IRS's decision to a higher court, that it would be decided differently. It's not something that we would recommend. The result is uncertain, and it's likely to go against the taxpayer if it's ever brought to court in another court case. So what are the conclusions we hope that you draw from today's webinar? The first one is, if we want to serve our clients well, I think that educating them about tax risk and uncertainty is a key part of that process. The key question for an advisor is this one: what kinds of tax uncertain strategy am I, the advisor, willing to advocate for on behalf of my client? And I think it's part of our job to cut through the tax junk so that we can help our customers make good tax choices and keep them from taking on unwanted tax risk. So I'd like to thank you again for joining us today. As a reminder, if you'd like to receive the supporting materials associated with this webinar, feel welcome to email us at asktheexpert@advancedunderwriting.com. That's asktheexpert@advancedunderwriting.com. You may also email questions related to today's content. Feel welcome to join us for the next webinar on the first Wednesday of next month, November 5th, at this same time. Next month's webinar will be titled Dynasty Trust Planning. You can find an archive of past webinars on our YouTube channel, Advanced Underwriting Consultants, and I'd invite you to please subscribe to our channel because it helps us to keep making free webinar content. Today's presentation will be posted on our YouTube channel by the end of this week. And finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. 1291. Thanks again and best wishes for continued success.